In this video, guys, let's talk about trading with seasonal biases. Stay tuned. Hey traders, warm welcome to you. Alright, so seasonal biases. There are websites, there are theories, there are kind of data that's backed up with backtesting that show that there are particular seasonal biases. Now this stems from the commodities market, when you would have specific requirement for commodities, whether it was farmers who had commodities that they were selling into the market would depress the price, or maybe a consumer who was buying crude oil for a specific reason, maybe seasonality for winter, etc. But now we're starting to see it in multiple different markets. We start to see it, these kind of seasonal biases, and all this data that's been crunched for things like gold, for stocks, etc. And we also can go a little bit more granular because we have seasonal biases where you might go, hey, a month is particularly strong historically. You might also have things like the Santa rally, so historically over Christmas and New Year there's some strength. There's some statistics to show that maybe the 3 days preceding a holiday are strong and the 3 days after the holiday tend to be strong or weak. Now I'm going to show you some places to get this data from in a moment, but I want to really talk about how you can use this data. So let's say, for example, you've kind of done this analysis yourself, or maybe you've subscribed to one of these services and found out this information. How are you going to actually use it? So there's a couple of ways to use this. So let's say, for example, we're in gold, and let's say we're coming into July, and let's say in July there's a seasonal bias that says, hey, gold historically from the month of July to August has been strong. So you go, okay, now in this sort of period here, now obviously it's hindsight, I'm just using this as an example, we'll look at where we can get this actual data from in a moment, but you can either do one of two things. The first thing you can do is you can buy at the start of the month and close at the end of the month and go, well, if I did this 10 years in a row, historically this is a profitable trade, and just take it on face value and trade it like that. Now obviously if you've got other time commitments and various other things and trading another vehicle, then this might be something to consider. But another way, and I think perhaps a better way of doing it, is to say to yourself, okay, I've got this data that shows a historical seasonal bias of strength in the month of July, for example, for gold in this example. So what I'm going to do is I'm going to only trade from the long side. So in other words, you're not just going to buy at the beginning of the month and sell at the end of the month. You're going to say to yourself, right, I've got a bias that's long, a statistically profitable bias, and listen, we don't know when it's going to stop, you don't know if it's going to carry on this year or whatever, you don't know that, but I'm going to trade my setups only from the long side, so that way your risk is still managed because your setups will still have the risk management criteria, they still have the stop losses in place, etc. You can fine tune the entry a bit because again, you're waiting for your specific setup, so you're just buying blindly in the market going against you for 2 weeks and then rallying and maybe closing slightly positive. You're waiting, so you can use the power of the statistical analysis with the combination of your existing setups and strategies. So this applies in all sorts of stuff, and guys, you can go to Amazon and you can pick up what's called the stock traders almanac, I believe it's called, and that gives you information. I haven't got a copy on my desk at the moment, I do have a copy of it, but that gives you kind of statistical information for each day. So not only have we got seasonality in terms of months, so you could say, okay, historically gold's been strong in this month, and natural gas and crude oil and some of these soft commodities have a much more seasonal tendency, but like I say, some of the stocks do as well. The old adage, sell in May, go away, Santa rally, this kind of stuff means that, hey, if you're coming into a Santa rally and you believe the data and you think, hey, between whatever it is, the 3rd of December to Christmas, there's always a good strong rally, then look for setups that align you with long. So the Stock Traders Almanac is a good one to look at. They used to do a Commodity Traders one, I don't believe they do anymore. I don't think that's available. There's also a website called Moore's Research, which is mrci.com, and these guys, I'll just bring them up for you. These guys offer some free stuff and some premium stuff. Go and check them out, like I say, mrci.com, and these guys will show you some seasonality tendencies. You know, so you can say, right, well, I'm looking for a seasonality, Canadian dollar, here's a seasonality tendency, and decide whether you want to trade alongside that or not. But the two ways of doing it, you just buy blindly and go, right, fine, I'm going to see what happens. And of course, you've got to use a relatively small position size, because you don't want to use a stop with that strategy, because ultimately the market could go against you and then come back in your favor. And the whole thing is, this is very often the case. So small size, or align yourself even better, I think, my opinion. Let me know your thoughts, guys, in the comments section below. But I believe that actually aligning yourself with the seasonal bias, or the seasonal tendency, or the statistical tendency, and then using a setup on top of that, stacks that layer of edge to hopefully align you with stronger and better trades. And whichever way you're trading, guys, keep your risk managed. Don't forget to check out our channel sponsor. It's a link from the description below. Take care. See you next one. Bye bye.